Ever wondered how many times the US stock market has crashed? It's a question that might have crossed your mind in passing but never really explored. Today, we're doing just that. In the next few minutes, we'll delve into the 10 significant stock market crashes that have rocked the United States, going through them in chronological order. From the panic of 1907 to the coronavirus crash, we'll cover it all. So buckle up as we journey back through some of the most tumultuous times in financial history. We start our journey in the early 20th century with the Panic of 1907. This event was a seismic shift in the financial world, marking the first major stock market crash in the United States. The panic was triggered by a complex web of factors, including market speculation, a tight monetary policy, and a lack of confidence in the banking system. It resulted in a widespread economic downturn and triggered significant financial reforms, and thus began a pattern of financial crises that would repeat throughout the century. Fast forward to the end of the Roaring Twenties, we find ourselves in the midst of the Great Depression. The stock market crash of 1929 was a cataclysmic event, triggered by a bubble of speculative investments. The immediate aftermath was devastating, with millions losing their jobs and their life savings. In the long run, it reshaped economic policies and attitudes towards financial regulation. The Great Depression was a brutal reminder of the volatility of the stock market. Let's shift gears to the 1970s, a time of economic turmoil catalyzed by the oil crisis. This period saw a severe stock market downturn triggered by a sudden spike in oil prices. The domino effect was immediate, causing inflation rates to soar and economies worldwide to reel. Yet, from the ashes of this crisis, there emerged a newfound understanding of energy politics and a drive towards alternative energy sources. The oil crisis was a wake-up call to the world about the interconnectedness of global markets. Next stop, the 1980s, a decade marked by the infamous Black Monday. On October 19, 1987, the stock market took a nosedive, erasing significant wealth in a single day. A combination of high stock prices, computer trading, and international disputes led to this crash. The aftermath? A swift recovery thanks to coordinated efforts by the government and financial institutions. Black Monday was a harsh reminder that even in times of economic prosperity, the market can still crash. As we move into the digital age, we encounter the dot-com bubble. The turn of the millennium saw an explosive rise and subsequent crash in internet-based stocks. This period, marked by overenthusiasm and overspeculation in tech stocks, led to a market correction in the early 2000s. Investors learned the hard way that not all that glitters in the digital world is gold. The fallout was severe, but the market eventually recovered, stronger and wiser. The dot-com bubble crash showed us the dangers of overspeculation in new technologies. Next, we come to one of the most significant financial crises in recent memory, the 2008 financial crisis. Often dubbed the Great Recession, this crisis was a whirlwind of housing bubbles bursting, banks failing, and stocks plummeting. The root cause? Subprime mortgage lending and a lack of financial regulation. The aftermath was a global economic downturn, millions of jobs lost, and a painful recovery process. The 2008 financial crisis was a stark reminder of the fragility of the global financial system. But the story doesn't end there. Just 2 years later, the markets faced the flash crash of 2010. A sudden whirlwind, it was a stock market crash that came and went within minutes. Algorithms and high-frequency trading were the main culprits, causing a rapid drop and rebound in prices. The aftermath, a shaken trust in the financial system and tighter regulations. But much like a phoenix, the market eventually rose from its ashes, restoring balance. The flash crash of 2010 showed us the potential dangers of high-frequency trading. And finally, we arrive at the most recent crash, the coronavirus crash of 2020. This financial cataclysm was triggered by a global health crisis, the likes of which we hadn't seen for a century. The pandemic-induced lockdowns led to a severe contraction in economic activity, causing stock markets to plummet worldwide. As we continue to grapple with the effects, it's clear that the road to recovery is a long one. The coronavirus crash has shown us the unprecedented impact a global health crisis can have on the financial markets. So there you have it. 10 times the US stock market has crashed. From the panic of 1907 to the coronavirus crash, we've witnessed the resilience and volatility of the financial world. Each crash, a stark reminder of the inherent risks, but also the potential rewards within the market. While these crashes have been devastating, they also serve as valuable lessons for traders and investors alike. Remember, history often repeats itself, so let's learn from the past to navigate the future.